Hey, my name's James Nicholson. Welcome to my YouTube channel. Look, if you've got a mortgage or you want to buy a property, you just like to know what's going on. It's good to know what the expectations are for interest rates. Well, in this video, I'm going to give you an update from a major interview with one of the key people at the Bank of England. They're saying what they feel interest rates should do, and this will give us an indication on what we might expect in next month's interest rate meeting and also the December meeting as well. So before we jump into this, if you haven't done before, do make sure you subscribe to the channel over there and hit that bell notification. By subscribing, you'll get all the latest house price news, interest rate news, property investing tips, and much, much more. And if you have a look around this video, we're a smidge away from 50,000 subscribers. So maybe you could be the 50,000th. And let's get some more views on this video. Your part's simple. All you need to do is smash like, tickle like, do something to that like button. That helps with the YouTube algorithm, and that really does help the channel grow. So thanks to everyone that does that. So, who are we talking about today? Well, the Bank of England, obviously. And one of the most senior people there, Hugh Pill. And so Hugh Pill is the Chief Economist at the Bank of England. And interestingly, in August, when rates dropped, he was one of the only people that voted against that cut. So he's not really keen on bringing rates down very, very quickly at the moment. And so he's been doing the rounds in interviews this week. And these interviews are important because you want to listen to what the Bank of England monetary policy members are saying, because it will give us an insight into where we think their vote's going to go. So we can pretty much say, because Hugh's saying, look, he doesn't think rates should come down too quickly. He thinks we should skip a few meetings and then reevaluate next year. So we can say pretty much 99% with certainty that Hugh is not going to vote to drop rates this year. So that's one person that's not going to do that. So what's he saying the problem is? Well, he's saying the biggest problem that we've got still is inflation. And so the inflation at the moment is at 3.8%. Next week, we'll give you some new inflation data. The expectations are that it will have risen again, probably nearer 4%, which isn't great. That's going to hit people really hard. Well, it's already hitting you, isn't it? Because this data is slightly lagging. So when you go to the supermarket, when you get your petrol, when you pay your energy costs, the things that you buy are already more expensive. And they've been there for some time. So the Bank of England's goal is two things, really. Bring inflation down to 2% and give maximum employment at that point as well. And so what they've looked at in August is, look, the forecasts aren't great. We're going to go back up to 4% inflation, but the unemployment's not looking great as well. But Hugh's more on the bandwagon of we've got to crush this inflation. And so where the rates sit at the moment, they are restrictive. So that means that they're not helping the economy grow. So people aren't looking at interest rates thinking, these are cheap, I'm going to go and buy lots of stuff. They're slowing down the economy, and you're seeing that because the economic data isn't good. 0.1% up, 0.1% down. It's not strong data by any means. People are suffering. And so Hugh's saying we need to see this inflation drop, and then at that point, the Bank of England will start cutting. But what do other places where we need to look at, and what rate expectations do they have? Well, one of the leading indicators, and what really matters, is not the Bank of England rate, it's the rate that your bank gives you. So you probably borrow from HSBC, NatWest, Santander, someone like that, right? And they borrow on a rate called the SONIA swap rate. And so this is a forecast on where their expectations are for mortgage rates, the Bank of England rate. Where do they think we're going? And recently, after we had that August meeting and the September meeting and the September data, they were looking at, they were rising. So what that meant that HSBC, NatWest, their costs increased. And we've seen that since August. So since the Bank of England cut rates in August, lenders have actually increased the rates that you borrow at. So what are the expectations today? Well, the last time the swap rate was updated was on the 15th of October. And let's have a look where that was. So let's have a look at it compared to September. So the 2-year and the 5-year, there's lots of swap rates for each period of time that you want to borrow at. 1, 2, 3, 5, 7, 10, 15, 30. 2-year and 5-year are what you're really bothered about because that's what your mortgage is likely to be. So the 2-year deal, SONIA swap rate in September was 3.69%. So that's why, even though the Bank of England is higher, lenders are able to lend you at around 4% plus fees because they can borrow at 3.69%. Let's have a look at what that is now. So the October 2-year rate, where are we sitting at now? Well, this is good because it's slightly better. It's gone to 3.6. So we've slashed off 0.09. So we're moving in the right direction there. So that is a good indicator that by the end of this year, you might see a few lenders drop rates to you. What about the 5-year rate? What was that doing in September? Well, the 5-year rate in September was 3.75%. And in October, the 5-year has improved slightly as well to 3.65%. So we're moving in the right direction there. That shows that the markets feel that we're going to get some rate cuts, but probably not as quick as we want. And that backs up what Hugh's saying here is that, look, we need to wait and see. Now, the other problem that you've got with rates is that America has no idea what's going on at the moment because their government is shut down. So the Federal Reserve has got a meeting at the end of this month in October, and they've got to decide whether they're going to cut rates. And they have no jobs data, they have no inflation data, they have nothing to go off. They don't know if it's good or bad in the market at the moment. And so they've just got to fly blind on that. Now, lots of people think that they may still cut because they think longer term, the unemployment in America is rising, the economy isn't looking particularly strong, the tariff stuff gives lots of uncertainty. So they still might cut, but they might wait until the government is back open to give us a real indication on where they're going. So these updates are important. These updates do give us the crystal ball to tell us what to expect. And this update tells me that you're not going to get a rate cut in November. According to Hugh, you're not. And according to Hugh, you're probably not going to get a rate cut in December. Let me know what you think about this in the comments below. And if you haven't already grabbed it, do grab our ebook, Mortgage Secrets, How to Get the Best Mortgage Deal in 2025 and beyond. This will get you the best broker for you. It'll also tell you the timings on when you should be remortgaging. Not only that, we'll talk to you about off-market lenders. You know, for car insurance, you've got Direct Line. Well, there's lenders that have some very competitive rates that are off-market for mortgages as well. They're in this ebook, so grab it in the description, grab it down below. If you haven't done, subscribe, let's get that 50,000, and check out all the other content as well on the channel, including this video right here.